Give it up for Danielle DiMartino.
Danielle DiMartino.
Danielle DiMartino Booth.
Danielle DiMartino Booth, CEO of QI Research, joins us once more, and we're speaking today on Tuesday, July 14th. Inflation just fell for the biggest monthly drop since April 2020. It declined by 0.4%, falling from 4.2% last month to 3.5%. We're going to examine the future of inflation and Fed monetary policy in response to inflation with Danielle. Welcome back to the show. Good to see you.
Great to see you, David. Thank you for having me back.
Let me play for you a clip of Warsh's testimony to the House Finance Committee earlier today. Take a listen and we'll react together. He was reacting, of course, to today's CPI data and the future of Fed policy in response to CPI. Let's watch.
Now, at the Fed, our number one objective is getting monetary policy right. That's our clear and constant aim, the star we steer by. And if we get policy right, and I can assure you we will, the inflation surge of the last 5 years will be a thing of the past.
The inflation we saw in the last 5 years will be a thing of the past. What kind of monetary policy of the Federal Reserve could ensure that, Danielle?
I suppose a greater degree of price disinflation than what we're already seeing, such that we go from 2.6% on the core CPI to 2%. And it seems like he is not ready to pull the plug on his mission until it is truly mission accomplished. He said in his remarks today that while the results were positive relative to expectations, that it was premature to suggest that the Fed's fight has ended.
But in theory, I mean, COVID was a supply shock. Mm-hmm. And I mean, what could the Fed do if we have a choke point, let's say, of the Strait of Hormuz closing down and oil spikes, or in the case of a worldwide pandemic? I'm not saying it's going to happen again, but in the case of constant demand and a supply choke point, the Fed's looking at tightening monetary policy and raising interest rates to curb inflation. I mean, is that the correct path forward here? Is that what he's prepared to do? What Warsh just said?
Well, bear in mind, Warsh himself has never said one way or the other. He was asked pointedly when he was in Portugal, does that mean that a rate hike is on the table for July? And he told the reporter, you're not going to trick me. I'm not going to say. So other Fed speakers are going to be all over the wires this week as we head into FOMC blackout and we all go quiet as of Friday. Yay. But given today's inflation report, if it was Powell's Fed, let's just say hypothetically, and the super core that Powell created printed negative and saw the steepest decline in 6 years, a lot of Fed officials would say that that was a good sign that core goods prices have fallen 2 months in a row. Christopher Waller, Federal Reserve Governor, yesterday was on the wires talking about the dangers of upside in core goods. Well, he got the exact opposite of that today. He got a negative 0.1% print, identical to May's negative 0.1% print. There was downside in homeowners insurance, automobile insurance, hotel, healthcare, and as well as used cars. Shelter, for example, printed 2.7% year over year. Housing did. That's in the 6th percentile of housing inflation prints since 2021. So it's clear that the policy that was put in place and the policy that has been in place since Warsh is there is beginning to work. As far as supply side shocks, can anything be done? No, but the Fed controls what's happening at the core.
Yeah.
And that is where we saw the improvement today, which was extremely unexpected. I would point out, David, I would say that 90% of traders on Wall Street were not looking for an unchanged print this month on the core. They were looking, the consensus was 0.2%, but the whisper was 0.3, 0.4%. And that's how the market was positioned coming into this report, for it to be a much hotter than expected report. And we've seen the exact opposite of that.
when you hear a statement like inflation will be a thing of the past, and then later on in the same testimony, I think a few minutes later, Kevin Warsh said that while monthly inflation numbers are noisy, I'm paraphrasing here, and then he said that long-term underlying inflation is caused by monetary policy. When you piece those two statements together, does that sound extremely hawkish to you?
It sounds constructive. It sounds not hawkish or dovish. It sounds like he's calling to the carpet prior monetary policy, not being aggressive enough in bringing down inflation. That's what that sounds like to me. It sounds like he feels like there should have been a more aggressive hiking path in the past to have brought that more under control. So, but he does see it as his duty. And I think we should translate that into coming into the report. There were all these rumors, and we were pricing in a Fed rate hike as soon as the July meeting. Those came off today. So now we look out to September. But again, I think the most likely path going forward is that we're going to see the Fed do a whole lot of nothing for some time to come.
Okay. Well, the core CPI was unchanged, easing to 2.6% year over year. You had said the super core was falling like a rock. Powell's super core inflation purchasing power is decimated. What does flat core confirm to you, or disconfirm, if anything?
Well, I mean, I think we've seen play out, what we were writing about in terms of our expectations. I mean, we have the lowest print since the Great Recession on U.S. families planning to travel. That's about as discreet as you get when it comes to talking about discretionary spending. And as you've noted, there is much in the way of heightened tension in the Strait of Hormuz all over again. That's going to translate directly to prices at the gas pump and depress even further discretionary spending plans related to travel. So the Fed will actually have to be at least cognizant that there isn't an overabundance of disinflation in discretionary spending, because that's never a good sign.
You've previously called the Fed's posture on inflation the biggest policy error in its history. Now, we're seeing evidence that inflation has cooled somewhat. Are you still sticking with this statement, or do you think that perhaps we're looking at an improvement in what could be positive effects of previous policy on current data? Let's put it that way.
Well, let's be clear. What I'm seeing is a Fed that has been higher for longer, to the extent that, according to Standard & Poor's, we've had 372 bankruptcies filed in the first half of 2026. That is the highest levels in 15 years, since 2010, when the economy was crawling out of the Great Recession. So I think the higher for longer policy is certainly continuing to do its work on a lagged basis. If you look at the sheer number of companies that are going out of business, and should that be Fed policy? Should Fed policymakers be taking a clue from what's happening in the credit markets? So far, I would say no. I would say that they've been ignoring it.
Before we continue with the video, let me tell you about one of your most important personal assets, which is your personal privacy online. If you've never Googled your name, do it now. You might be surprised at what comes up. Data broker sites and people search sites are quietly collecting your personal details, such as your name, home address, and phone number, making it very easy to find. Delete Me, today's sponsor, is what I use to fight back against that. After a quick setup, they scan for where your personal information appears, verify those listings, and submit removal requests to hundreds of broker websites. They also continue monitoring over time, since this information can reappear over time. I've personally been using it for over a year now, and it's removed 204 of my listings, and my latest report showed 335 listings were reviewed last month. So if that bothers you as much as it bothers me, then use my link in the description down below, or scan the QR code here. That's joindeleteme.com/DavidLin, and use my code DavidLin to get 20% off. Take control of your privacy today. Overall then, are you expecting the bond market to react further to Fed policy later this year in the form of higher interest rates on the long end of the curve?
David, I think a lot of that depends on where we go from here. If we continue to see downside in core, I would say no. We've seen a continued deceleration in the labor market. And
Yeah.
even though Chair Warsh likes to talk about price stability almost exclusively, if we were to continue to see a weakening in the job market, we had ADP's weekly data out today that printed at the lowest level since March. If that weakness continues, I think that the discussion shifts pretty quickly away from the prospect of Fed rate hikes and again to how long the Fed's going to stand pat in what is clearly, again, still a higher for longer monetary policy stance, given the continued fallout in the credit markets, as well as Lending Tree reported just a few days ago that it's seeing personal bankruptcy filings up 50% year over year. So something is working, David, in the sense of restrictive monetary policy. Is it reflected in the financial markets, as Warsh has pointed out? No, it's not. Are we seeing high yield bond spreads gap out? No, we're not.
Yeah.
So I think that he's going to maintain his hawkish stance if he doesn't see any of it reflected in the financial markets.
My first reaction looking at today's CPI, and admittedly, I haven't broken down the entire report myself, line by line. But if someone were to ask you, I mean, a lot of it did come to the fact that inflation was down because the gasoline prices came down somewhat since a month ago. So if someone were to ask you, well, inflation is on a downward trend simply because oil has fallen, how much of that statement would be true versus, let's say, inflation coming down regardless of where oil is due to monetary policy?
I would say that they need to look well beyond the headline. Again, this was a completely unexpected core print, completely unexpected. And that has nothing to do with energy prices. I take that back. Restate, that has to do with energy prices and the knock-on effect that it has in terms of households' ability to buy other things. What we did see advertised large in today's CPI report is the continuation of a margin squeeze. Firms continue to have a very hard time passing along higher input prices to end consumers. And that's a problem. That's a problem because the greater the margin squeeze, the more companies are compelled and forced to be in a cost-cutting mode. And companies cut costs the way they can with what they can control, and they can control headcount.
Okay. The oil price is now at $78 a barrel. Danielle, can we take a look at this statement from President Trump that he posted on Truth Social just a couple of days ago? The Hormuz Strait is open and will remain open with or without Iran. We are reinstating the Iranian blockade, so named because it is only stopping Iran's ships or customers from entering and leaving. This happened a few months ago. It's stopped now. Apparently, he's reinstating it. As we speak, a large portion of the U.S. Navy is being moved to the Persian Gulf as reinforcements. The USA will be, from this point forward, known as the guardian of the Hormuz Strait. Importantly, he said, but as such and as a matter of fairness, we will be reimbursed at the rate of 20% on all cargo shipped for any and all costs necessary to do the job of providing safety and security to this very volatile section of the world. How are you interpreting this statement? And overall, then, are you looking at a reignition of oil prices such that inflation, the print that we saw today, is going to be much higher again later on in the year?
So, I think that there is a distinct possibility. We're obviously seeing it. We had seen West Texas Intermediate down at $68 a barrel. Now we're at 79. My only caution would be at this point that Trump has seen fit to back off of that. He has shelved the 20% because he's probably been spooked by the fact that prices are up as much as they are. There is a Hormuz Strait tracker, and you can follow in real time traffic in and out of that strait. And until the traders in the oil pits see a pronounced increase in that traffic, regardless of what's promised by either side, there's not going to be relief at the gas pump.
Remarks that Warsh made later on during the testimony, he said that layoffs have not been that high this year. The unemployment rate hasn't changed much from previous years, and the labor market hasn't significantly deteriorated. That's this assessment on the overall strength of the economy. What's your assessment?
Well, we've got 27% of the unemployed, more than 20% of the unemployed who've been out of work for 6 months or more. That is a recessionary level of what we call scarring, permanent job loss. We saw 720,000 Americans fall out of the labor market last month, bringing the labor force participation rate to 61.5% outside of COVID. That was the lowest level since 1976, when we were celebrating the bicentennial here in the United States. So I think it's easy enough to say we haven't seen a bloodbath in layoffs, but there have been plenty of job cuts announced this year. We are just now getting into earnings season. Earnings season is the favorite time for companies to boost their stock price by announcing layoffs. Silicon Valley is definitely in a state of shock because there have been so many layoffs in the tech sector. So I think, to use Chair Warsh's term, I think it's premature to say mission accomplished when it comes to the labor market.
Yeah. And by the way, also I wonder how much of the non-farm payrolls added in the last two prints were due to short-term hiring due to FIFA in the US. And once that ends, maybe we could see that decline a little bit in terms of hirings, and that may reflect in the labor data and look on the surface as though maybe the labor market is weakening when in fact it's really just a return to normal before FIFA.
No, I mean, we actually already saw that. We saw a several sigma event in terms of the job losses in leisure and hospitality. We've certainly seen a marked decline in job openings in that sector as well. So you're right. It could just be a boomerang effect. By the same token, companies had been enjoying the proceeds from income tax refunds, and that has more than worked its way out of the system. Again, at a time when we were just talking 3 hot minutes ago about the fact that West Texas Intermediate's right back up there close to $80 a barrel.
Yeah. Okay. Well, what are the chances of a credit event happening now that interest rates look like, as we talked about earlier, could be on the rise, and we have potentially a danger of a lack of liquidity if conditions deteriorate? What do you think?
Well, this credit market, it's a dog that does not bark. It has not cared about defaults. It has not cared about the bankruptcy cycle. It has not cared about the unseen defaults in the private credit market. But we are beginning to see pushback when it comes to investors being wary of companies rushing to market with IPOs. Samsung just today said, you know what, we're going to float some equity out there as well. It's to a company, it looks like free money. As long as the Korean market's up, let's just go ahead and issue equity because the market's starting to choke on all of this debt issuance for AI. But as far as a credit event in the public credit markets, we're not there yet. Triple C bond yields have definitely gapped out. We have definitely seen investors reflecting the higher probability of the lowest rated credits breaking. But in terms of the broader market, we're certainly not there yet.
Okay. We're looking at the U.S. mega banks beating expectations in Q2 2026. So collectively, they've reported $49 billion in profits from the latest quarterly reports. JP Morgan Chase reported a record profit of $21 billion. That's a 41% jump year over year, boosted primarily from investment banking fees. Goldman Sachs also surged past expectations, staggering 78% profit jump over the last year. Citigroup saw profits climb 45%. Bank of America saw profits climb 27%. Wells Fargo up 17%. The banks were just killing it last quarter. Is this an indicative of improving credit conditions, you think?
Oh, I wouldn't say it was necessarily improving credit conditions. We know that they're lending like gangbusters into the private equity, private credit sector. And that's bound to be lucrative. We know that trading revenues were just incredible. We know that a lot of companies that investment banks helped merge in recent years, now they're helping them divest assets, which is great, right? When you broker a marriage, you collect fees, and when you say, "Well, the marriage didn't work out, but I'm still a lawyer, I'm going to still collect fees on the divorce." I mean,
Fair
investment
enough.
banks are brilliant because they get to collect fees on the way in and on the way out,
Yeah.
and there's no doubt in the world that they're masters of their craft. But in
Would,
terms
would,
of
would,
consumer lending, that actually barely moved compared to what we're seeing in terms of lending to hedge funds for leverage, lending in the non-depository lending institution space, lending into the shadow banks. That's been increasing a lot, but to consumers, not so much.
would you be long financials at a time when interest rates are rising?
We are not in the position. It is not our position to be long the financials right now. They're in the process of finally realizing taking losses on commercial real estate. And as we've heard from the Dallas Federal Reserve Banking Conditions Survey, um, they're tightening lending standards right now. Typically, when banks are battening down the hatches, that's a sign that even though they're getting great investment banking fees, if they're not extending loans into the real economy, that's a sign that credit is deteriorating.
Okay. So give us an overview of the commercial real estate market right now and why it's been deteriorating.
Well, I mean, you're seeing RealPage announced that for the month of June, the number of weeks of concession on average reached out to six. That's 6 weeks of concession. That's the most in data that goes back further than 25 years. So multifamily is clearly struggling. We know office is in distress and that market is clearing and that we're seeing crazy discounts. But that market clearing is actually good news for the commercial real estate sector. But it's what's coming next in terms of multifamily and retail and lodging, where we have to be really careful because those are kind of the next shoes to fall for the commercial real estate industry when it's very difficult to access credit and equity when it comes to that massive multifamily sector.
Yeah, if shelter continues to stagnate in terms of growth, and let's say shelter costs don't go up at the same pace, would that alone be enough to persuade the Fed to pause on any potential rate hike plans?
I mean, shelter inflation has been in a state of disinflation for months now, and it certainly hasn't swayed Fed policymakers. They've been more focused on, as Waller said yesterday, core goods inflation possibly taking off. Of course, it didn't.
If we're to look ahead at what could possibly cause the Fed to lower rates this year, right now the CMA 5 Watch 2 is not pricing in any chance of a cut by December. What would those criteria be if we were to outline a few possibilities here?
I think we would have to see continued cooling in the core CPI, and we would have to see continued weakening in the job market. Of course, we have seen that in the job market. We have seen weakening there. But I would have to say a continuation of that alongside more disinflation.
Okay. And are there particular levels for unemployment, the unemployment rate, or let's say a trend for non-farm payrolls added that you would need to see before you're convinced that the labor market has started to show signs of strengthening, or at least is resilient to the point where the Fed doesn't have to worry about the labor market anymore?
Well, certainly. I mean, if we were to start to see 200, 250, 300,000 jobs being created every month and the unemployment even stay as low as it is, but not for reasons of people dropping out of the labor force, which is what caused it to go down. Certainly, if we were to start to see the private sector, which I certainly hope happens, re-engage and start hiring aggressively, that would be a fabulous sign. And that would be a sign, especially if the opposite occurs, if the core CPI was to start heating up from here, then the Fed would certainly have a case with a buoyant and growing and robust and solid and strong job market combined with heating inflation on the core level. Yeah, the Fed would certainly have a case for hiking here.
Okay. Walk us through the lag effect of a higher for longer policy and what we could see as symptoms of a higher for longer policy. potentially deteriorating credit conditions for consumers, right? We're looking at, we've already seen the most bankruptcies since the great financial crisis in the last couple of years. How does this translate to the consumer level?
Well, as I'd mentioned in passing a few minutes ago, when Lending Tree comes out and says that they're seeing 50% year-over-year growth in personal bankruptcies, it shows you that what was happening kind of isolated to the corporate universe in terms of Chapter 11 filings now is finding its way through to households. We forget that of the 42 million Americans with student loans, there were 7 million who had not paid, who still have not paid since March of 2020. But as of October the 1st, which is kind of the 90 days past due mark from July 1st, when there was a law change that was tied to one big beautiful bill, as of October the 1st, even the last of those 42 million, that last 7 million will start to see their credit impaired if they have not resumed paying back their student loans. And you can, name anything you want. Americans making minimum credit card payments. Edmunds reporting that a record number of Americans have car payments that are north of $1,000 a month. Any of these things alone tell you that the consumer is in distress. Add them up, and that takes you to where we started this little discussion about personal bankruptcy filings rising to the extent that they have.
Okay. Well, let's look at investment implications then. Would you be short or long duration at this particular point in time?
That's a really, really, really tricky question. Really, really, really tricky. But I would say that that the vast majority of the market has been positioned for short rates to rise. And since I'm a contrarian by nature, if we are to continue seeing downside, we saw Germany, we saw their wholesale prices print overnight with a negative number in front of them for a second month in a row. So if disinflation, if these trends are going to be global in nature, and we're going to see pass through, or the inability to pass through higher costs continue to be reflected in CPI and PPI, and I think the market starts betting that the Fed's at least going to go on the sidelines, which would take the 2-year Treasury down. So I would say the shorter tenures from here, because they've blown out so much, would be a good place to be.
What would the Fed need to see in order for them to engage in yield curve control in some form or fashion?
So, I think if the 10-year was to rise dramatically from here, such that a credit crisis itself was the risk, then we could potentially see something of that nature. But again, yield curve control would imply that we were already at the zero bound.
Yeah.
And we're still debating rate hikes.
Okay, and then on equities here, the tech trade, there's been warnings that the AI bubble, showing signs of at least slowing down when it comes to growth, not just a burst, but just slowing down for now. Are they completely different stories, Fed policy and the tech trade, ultimately stocks driven by earnings? Are they related at all? Can you find some sort of common denominator here?
Well, you certainly can find a common denominator in terms of the credit markets being wide open and supporting the AI trade, which they have. I don't think that one can survive without the other. So Fed policy, even if it's indirectly tangentially, has an effect on the credit markets. So I don't think you can separate out the two, especially when private market valuations are playing such a large role in bolstering the hyperscaler profits.
But is demand for chips and data center build-outs strong enough to withstand higher interest rates? In other words, how resilient is the tech sector to, let's say, a much tighter Fed? Do we have any evidence to suggest that they can withstand a 2022 type hiking scenario?
I would think that would be difficult on the riskiest assets, for sure.
Okay.
Yeah. Plus, you're forgetting the fundamentals here, right? There's technologies in China that suggest that individuals are spending approximately 98.5% too much to access the same technology that they could in China. So I think that there are deeper, more existential questions at work right now that are beyond my pay grade. I'm an economist. I'm a market strategist. I'm not a quantum physicist.
All right. Well, let's follow up when we have quantum computers at Walmart for us to buy. Maybe in a few years, who knows? Finally, gold and precious metals. Have we found a bottom here at around $4,000? Bit of resistance here on the floor yesterday as gold fell, but hasn't really substantially broken below 4,000. What do you think?
I did say a few weeks ago publicly that I thought that that we were definitely coming to the end of the consolidation era, where many of the tourists had been washed out of the trade and gotten to the point where it was feasible that that this was time for fundamental players in the space to come tiptoeing back in.
Okay, excellent. Danielle, thank you very much. Where can we find your work?
So please come to dimartinobooth.substack.com if you'd like to become part of the Daily Feather reading community. And if you run money for a living and we'd like to be part of our institutional community, Bloomberg chat room's always interesting and colorful, then please come to QI Research.
All right, we'll put the link down below. So please do follow Danielle there and QI Research. Appreciate it, Danielle. Good to see you again as always, and I look forward to next time.
Likewise.
Thank you for watching. Please do follow Danielle on the links down below and do subscribe and like this video. Take care. We'll see you soon.